First and foremost, what was the point of the whole exercise with this Africa Markets Revealed report?
I think the overall purpose is really to cover most of the African countries which have sort of emerged as important countries with the world watching frontier markets as well as emerging markets. And of course it also reflects Standard Bank's interests in the rest of Africa, where we've invested in a number of countries. I think the Revealed also covers a number of other countries where we don't have such direct interest, for example, as in Egypt. But generally we look at financial markets in countries where we have sort of large operations. Typically it would be Nigeria, Ghana, Kenya, Mauritius, Botswana, and so forth, Uganda, Tanzania. Those are sort of the main ones. Also, of course, the emerging ones, the important ones, such as Angola, as well as Mozambique.
Let's talk about the frontier markets, the ones with great potential but need heavy investments in infrastructure and new industries. Botswana, always the darling of the World Bank and the IMF in terms of governance standards, consistent growth, management of the economy, and we're expecting growth of 6.3% in year 2012. It's a significant recovery to what happened in 2008, 2009.
Yeah, it is indeed, as you say. I think the main reason for that is, as you alluded to, the institutional environment is very important. But of course, you need to look at prices, and if we look at polished prices, made a miraculous recovery just after that world recession and reached substantial heights last year. Although towards the end of last year, the polished diamond prices started easing a little bit. However, Botswana's diamond production is sort of back on full steam, and so the outlook for the industry is, at least in the shorter term, reasonably positive. Of course, we expect in the longer term that some of the diamond mines, or the diamond abundance, will be lower as some of the mines get mined out, and lower grade ore and value will be extracted. So in the long term, it's unlikely to yield the same kind of benefits to the country as it has in the past. But I think policy is quite clear about diversifying the economy, and there we can think about the financial sector, the energy sector, which is receiving now a huge amount of attention, of course, and then the tourism sector.
Okay, we have seen inflation figures coming through for December, and overall, Botswana's inflation is still way above what the inflation target is. So there is a need to stimulate growth, but there's also a need to rein in prices, which have risen significantly in Botswana.
Yeah, typically Botswana is a high inflation country. I think it's because perhaps population density, or lack of that, or low population density is a factor. Also the size of the market, there may be structural impediments to distribution and so forth. Much of Botswana's inflation, of course, is also imported from South Africa, which is an important import partner. But there must be some markups in terms of transport costs and so forth.
Right. Let's move over to Malawi, which got a lot of attention for all the bad reasons last year, falling out with donors, etc. We're expecting lower growth at 6% this year. What's going to drive that growth, and how's the government going to manage its revenues if it doesn't have a consistent stream from foreign donors?
Yeah, that's indeed a problem. I think the main center of the Malawi's problem would be the foreign exchange rate, and that is typically pegged, and it's been very controversial in terms of the view that the IMF has taken in terms of its policies towards Malawi. Of course, what has happened, the exchange rate has been overvalued, and therefore there's been foreign exchange shortages which had a knock-on effect on imports of essentials such as fuel and medicines and so forth. So unless that kind of structural impediment is removed, which will imply a depreciation to more or less to the parallel market rate about 240 to 250, eventually from 165 presently, because that, as I said, it introduced a number of structural distortions. Right. The other thing is, of course, the diplomatic spat with the UK, and a number of donor organizations are withholding funds, special budget support. But that needs to be sorted out. The other problem, of course, with devaluing your currency is that the government has run a very successful farm input subsidy program, which really resulted in Malawi becoming self-sufficient in food. Okay. So in fact, food inflation is extremely low. Right. It's fuel inflation which is high. But with the devaluation, the costs of this farm input support program will rise, because it implies fertilizer and seed costs will now be higher.
Let's talk about project. Let's talk about project
and budget constraint.
Let's talk about project financing very briefly, because I want to move on beyond Malawi. They should get an injection in the form of foreign direct investments, with talk of the Brazilian company Vale building a railway line between Mozambique and Malawi for freighting coal. So some of those sorts of investments should help to lift the economy and some of those liquidity constraints.
Yes, indeed it will. It's the Vale investment will amount to about $1 billion over a 3-year period, and it will be to build a railway line and I think rehabilitate some of the existing railway lines, and that is really to ship some of Mozambique's coal through the southern part of Malawi to the port of Nacala on the coast in Mozambique. But it will also mean that it will cut transport costs for Malawian goods, which it will also carry. It will not only carry Mozambican coal, but it will transport costs or transport savings is I think estimated about at $100,000 per annum, and lower transport costs by about 40%. So that FDI will certainly also stimulate further investments within the country.
Tell me about Mauritius, because we know that they've been very vulnerable to events in Europe. It's definitely knocked the rupee, it's knocked the tourism sector, and to an extent, even though there's a higher demand for sugar and prices are rising, that sector alone cannot be the lifeblood for this economy. So with growth estimated at 4% this year, what's going to boost Mauritius's chances of a better performance?
I think it's mainly going to come from the sugar sector. The recent government estimations for sugar production is much higher, the last estimations, compared to about 6 months ago. So I think it will be really the sugar sector that will boost boost growth. Also, the fact is that sugar prices have reached new highs. I think the other problem is the tourism sector, and the government has made, I think, good progress in trying to diversify the source of tourists away from the European Union, which we all know is, or expect to be in recession, going into recession this year. They're diversifying towards getting tourist arrivals, or increasing tourist arrivals from China and India.
Right.
Of course, the problem there may be that China is also now slated to possibly slow down. So it's going to be a difficult year, but I think the authorities are well aware of all the risks and will take the appropriate action.
Okay, all right. And then finally, your outlook for Namibia, because we're told this is the one country that's managing inflation, that's attracting FDI. It probably is going to be an oil economy if exploration results are positive. There continues to be interest in uranium mining. So, off the surface, Namibia looks good.
I think it does look good indeed. I think, especially the oil discovery, which was sort of announced at the end of the middle of last year, but that will only come on steam within 3 or 4 years, and I think that could transform really the shape of the economy in years to come. But I think the immediate impact won't be seen as yet.
Okay, thanks so much for your time. We have to leave it there.